Here is a number that should stop you cold. Your mortgage, your 401k, your grocery bill, they're all about to get hit by a $38 trillion monster that Washington doesn't want you to understand. The United States government is currently spending $1.1 trillion every single year just to pay the interest on its national debt. Not to build infrastructure, not to fund the military, not to pay for healthcare or schools or any service you can actually point to and see. Just the interest, the cost of servicing the debt that already exists. That single line item, interest payments, now officially costs more than the entire national defense budget and the entire Medicaid program combined. One line, more than both of those programs put together. And sitting behind that number is a $38 trillion national debt that is becoming harder and harder to ignore. That is not a political talking point. It is a mathematical reality appearing on a federal balance sheet, and it is a number that has forced the largest pools of capital in the world to make fundamental changes to how they invest, changes that directly affect your retirement account, your mortgage rate, and the purchasing power of every dollar you earn and save. BlackRock manages over $14 trillion in assets. It is the largest asset manager in the world, and its 2026 Outlook report contains a specific and significant signal. BlackRock has moved long-term U.S. Treasury bonds to an underweight position in its model portfolios. That is a formal way of saying we are reducing our exposure to U.S. government debt. When an institution of that scale quietly and systematically changes course, most people do not notice. The moves are buried in quarterly reports, disclosed in technical language, and covered, if at all, in financial press that most people do not read. But those moves are happening, and where that capital goes next matters enormously to ordinary Americans who are connected to these markets through their 401ks, their pension plans, and the value of their homes. So let's walk through exactly what is happening, why it is happening, and what the average person can actually do about it, not in vague motivational terms, but specifically and practically based on the same logic driving BlackRock's decisions right now. To understand the shift that is underway, you need to understand what the bond market is actually telling us. There is a concept called the term premium. It is the extra yield that investors demand in exchange for locking their money into long-term government debt instead of short-term debt. If you are going to loan the US government money for 30 years instead of 3 months, you want to be compensated for taking on that additional time risk. The term premium is that compensation. That premium is rising steadily, and when it rises, the bond market is communicating something specific. Investors need to be paid more to take the risk of holding government paper for the long term. The risk they are pricing in is not a stock market crash or a corporate default. It is persistent inflation and fiscal instability, the risk that the US government will keep spending more than it takes in, keep issuing new money to cover the gap, and keep slowly eroding the real value of those fixed bond payments over time. Here is the core mechanical problem. The government cannot sustain its current spending trajectory without continuously issuing new debt. Every year the deficit exists, new treasury bonds have to be sold to finance it. But that flood of new supply is now hitting a market where the traditional buyers, the Federal Reserve, which was buying treasuries by the trillions during quantitative easing, and foreign central banks, which held US debt as reserve assets, are both stepping back rather than stepping up. Basic economics applies here. When supply goes up and demand retreats, prices fall. When bond prices fall, yields rise. When yields rise on new issuance, the old bonds sitting in your portfolio at lower yields become worth less. For someone holding a 30-year treasury bond in that environment, rising yields create a specific and painful outcome. The fixed coupon payment on that bond does not adjust for inflation. The bond pays you the same dollar amount every 6 months, no matter what happens to the price level. But if inflation is running above the target rate and your bond yield falls short of it, you are losing real purchasing power every single year you hold it. The math does not care about your intentions. The bond is a wasting asset in this environment. BlackRock's analysts have concluded that the US government simply cannot sustain its current spending levels without issuing massive amounts of new debt. Larry Fink and his investment committee have recognized that the risk-free rate offered by treasuries is no longer sufficient to offset these risks. This realization that long-term US government bonds may no longer reliably protect and grow capital in the current macro regime is what is driving a fundamental reallocation of institutional capital, and the destination for that capital tells you everything about where the smart money thinks value will actually be preserved in the years ahead. The clearest answer is real assets, specifically infrastructure and energy. And the logic behind that shift is simple enough to explain in a single comparison. A highway toll road can raise its toll 3% a year to keep pace with inflation. A government bond cannot. A natural gas pipeline charges a fee per unit of gas transported, and that fee can be renegotiated upward when its long-term contract renews. A government bond cannot. and airport charges, landing fees, gate fees, and retail rents, all of which tend to rise with the general price level over time. A government bond cannot. When you own assets that have pricing power contractually embedded into their revenue structure, inflation works in your favor. When you own a fixed coupon bond, inflation is your enemy. That single asymmetry is driving trillions of dollars in movement right now. BlackRock made this logic concrete with a $12 billion acquisition of Global Infrastructure Partners. The assets acquired include Gatwick Airport, the Port of Melbourne, and extensive natural gas pipeline networks across multiple continents. These are not growth assets. They are not exciting, disruptive technology plays. They are boring, essential, irreplaceable pieces of physical infrastructure that generate revenue because they simply cannot be avoided. You cannot reroute international air traffic around Gatwick. You cannot redirect the port traffic of Melbourne to somewhere cheaper. The demand for these assets is structurally inelastic, which is another way of saying they have pricing power regardless of the economic cycle. By swapping government bonds for airports and pipelines, BlackRock is effectively making a specific bet that hard assets, physical, essential, inflation-linked, will preserve real value in a way that paper promises backed by a heavily indebted sovereign cannot. This is not a radical fringe view. This is mainstream institutional portfolio management, and it has profound implications for the standard model of retirement savings that most Americans are still using. For decades, financial advisors recommended building retirement portfolios around a basic formula: 60% stocks, 40% bonds. The logic was elegant. Stocks provide growth, bonds provide stability and income. And critically, when stocks fall, bonds tend to rise because investors flee to safety. That negative correlation between stocks and bonds meant the 40% bond allocation acted as a genuine shock absorber during market downturns. That model worked remarkably well from roughly the 1980s through 2021. Interest rates were generally declining over that entire period, which meant bond prices were generally rising. That 40% allocation was not just stable, it was actively appreciating much of the time. Then 2022 happened. In 2022, both stocks and bonds fell simultaneously. The stock market dropped roughly 18%. Long-term treasury bonds dropped roughly 30%. The protection that the 60-40 model promised, the shock absorber, was not there. Both sides of the portfolio fell at the same time because both were hurt by the same force: rising interest rates. The negative correlation that made the model work had broken down. BlackRock is now signaling that the era of reliable negative correlation between stocks and bonds is over, and a new diversification strategy is required. In an environment of higher for longer interest rates driven by persistent fiscal deficits, bonds and stocks may continue to fall together during stress events rather than moving in opposite directions. The diversification benefit that justified holding 40% in bonds may simply not exist in the new regime. This is not a minor technical adjustment. It is the dismantling of the foundational assumption underlying how most American retirement savings are managed. If you are currently holding a target date fund in your 401k, the default option for millions of plan participants, that fund is heavily weighted toward bonds as you approach retirement age. The logic was that you need stability as you get closer to needing the money. But if bonds are no longer providing stability, if they are actually adding volatility in the same direction as stocks, that logic does not hold. Public pension funds face the same problem at an enormous scale. These funds hold massive allocations in fixed income assets specifically because they have to meet long-term payment obligations, the monthly checks going to retired government employees. If those bond portfolios cannot generate real returns, if they are losing purchasing power to inflation every year, the fund's ability to meet their obligations deteriorates, the funding gap widens, and ultimately, taxpayers are the backstop for those gaps. Now, beyond bonds and infrastructure, there is another piece of this structural shift that receives less attention, but is arguably just as important: the dramatic expansion of private credit markets and what it means for the financial system most Americans interact with every day. BlackRock has finalized the acquisition of HPS Investment Partners in a $12 billion deal. This is not just another corporate merger. It is the final piece that transforms BlackRock from an asset manager into what analysts are calling a shadow bank. Through this acquisition, BlackRock now controls a private credit platform that rivals the lending power of the largest institutions on Wall Street. For decades, if a company like General Motors or AT&T needed to borrow money, they went to a commercial bank like JP Morgan or relied on the public bond market. But today, banking regulations, specifically the Basel III Endgame capital rules, have made certain types of lending significantly more expensive and operationally burdensome for banks. Banks have pulled back, and BlackRock has stepped into this void. They are now the lender of choice for corporate America, bypassing the Federal Reserve's banking system and its strict capital requirements. The loans are negotiated privately, the terms are not publicly disclosed, and BlackRock faces significantly less regulatory oversight than traditional banks. The decisions about who gets capital and who gets starved of it are now being made in a private boardroom, not a bank branch. When you control the debt of a company, you control the company itself, often more effectively than the shareholders who own the stock. This matters enormously for individual investors because the investors in these private credit funds are frequently the pension plans and 401k target date funds that hold the retirement savings of ordinary Americans. If those private credit portfolios experience significant defaults, which every credit cycle eventually produces when underwriting standards loosen enough, there is no Federal Reserve lending window to bail out a private credit fund. The losses flow directly to the fund investors. The risk that used to sit on bank balance sheets, backstopped by FDIC insurance and Fed emergency facilities, has been transferred to the personal balance sheets of American retirees. Most people do not know this is happening. There is another consequence of this shadow banking expansion that affects every American who has ever applied for a loan. When BlackRock lends $1 billion directly to a technology company, that is new money entering the economy without the Federal Reserve's permission or oversight. This shadow money creation is inflationary. It actively counters the Fed's attempts to slow the economy through rate hikes. It is one of the key reasons the economy remains surprisingly resilient despite the most aggressive rate hiking cycle in 40 years. The credit kept flowing, but through private channels that are invisible to the traditional economic metrics. This is what economists call the crowding out effect in reverse. Instead of government debt crowding out private borrowing, private credit is now flowing so freely through unregulated channels that it undermines the Fed's ability to control inflation at all. The official data on inflation and growth is becoming increasingly disconnected from the reality of what is actually happening in the economy. There are already visible signs of stress. Payment-in-kind loans, where borrowers pay their interest not in cash but in additional debt, are increasing. This is a classic late cycle signal. It means some borrowers are already unable to service their debt with real cash flow and are instead rolling interest costs into growing loan balances. When this dynamic becomes widespread enough, the cycle breaks. And who absorbs the losses? The pension funds, the endowments, and the target date funds in your 401k. The risk has been successfully transferred from the bank balance sheets to your personal balance sheet without your consent. And this connects directly to a development worth watching very carefully inside your own retirement account. BlackRock is aggressively lobbying to include private equity and private credit funds in the standard target date funds used by millions of 401k participants. The stated argument is that private assets offer higher long-term returns and that retirement savers deserve access to those returns. That argument is not entirely wrong, but the return premium comes with a fundamental trade-off that tends to receive much less emphasis in these conversations: illiquidity. Private assets cannot be sold daily. They are locked up, typically for years. If a private equity fund is included in your target date 401k and the market crashes and you lose your job and need to access your retirement savings, a portion of your account may simply not be accessible without severe penalties, or at all until the lockup period ends. It is the ultimate Hotel California of finance. You can check your money in any time you like, but you can never leave. You would have contributed your paycheck into an account, watched the balance grow on a statement, and then discovered in the moment you actually needed it that the money is trapped. BlackRock collects the management fees consistently. The retirement saver bears the illiquidity risk alone. They are effectively using your retirement savings as the permanent capital base to fund their private empire of infrastructure and debt, while you take the risk of not being able to access it when needed. Now let's talk about one specific sector where BlackRock's investment thesis becomes particularly visible and particularly consequential: electricity. Artificial intelligence is not primarily a software story at the infrastructure level. It is an electricity story. Training and running large AI models requires data centers, and data centers require enormous and growing amounts of power. The energy demands of the AI boom are measured in gigawatts, and they are growing faster than the grid was designed to accommodate. BlackRock knows this. We are currently tracking verified reports that BlackRock's subsidiary, Global Infrastructure Partners, is in advanced talks to acquire AES Corporation, one of the largest power generation companies in the world, supplying electricity to millions of homes and businesses globally. That potential takeover would be valued at approximately $38 billion. The timing is not a coincidence. It is a direct play on the exploding energy demands of artificial intelligence data centers. You cannot run an AI model without electricity, and you cannot transport goods without ports. These assets are inelastic in demand, which is exactly what makes them attractive replacements for government bonds in a portfolio. BlackRock is positioning itself as the toll collector for every byte of data processed by the future economy. But this creates a conflict of interest that should concern every American who pays a monthly electric bill. If BlackRock owns the power grid, will they prioritize selling electricity to high-paying AI data centers over residential neighborhoods during a shortage? Will your grandmother's electricity rates rise because she is competing for kilowatts with a trillion-dollar tech company's server farm? These are not hypothetical questions. They are the logical consequence of privatizing essential grid infrastructure, and this AI energy build-out is being funded in part by the very pension dollars of the people it will ultimately affect. There is also a chapter in this institutional story that deserves attention specifically because of what it reveals about how these decisions are actually made, and it involves the sudden and complete reversal on ESG investing. For several years, BlackRock was among the most vocal champions of environmental, social, and governance investing frameworks. Larry Fink wrote letters to corporate CEOs demanding climate action. BlackRock joined the Climate Action 100+ Coalition, a global group of investors pressuring companies to decarbonize their operations. The language of stakeholder capitalism dominated annual shareholder meetings and investor conferences. Then the state of Texas withdrew $8.5 billion in pension assets, accusing the firm of boycotting the oil industry. Other states made similar moves or threatened to. The response was swift and complete. The term ESG disappeared from BlackRock's U.S. filings almost overnight. BlackRock withdrew from the Climate Action 100+ Coalition. Public messaging shifted from climate action to energy security and infrastructure resilience, terms with bipartisan appeal that do not carry the same political baggage. What does this reveal? Simply this: the only consistent variable in institutional investment decision-making is asset retention. When a particular ideological stance threatened to cost assets under management, the stance was abandoned. Larry Fink, who once wrote letters demanding corporate climate action, stopped using the term ESG in U.S. filings almost overnight. The ideology vanished. The management fees survived, but do not mistake this tactical retreat for a total defeat. BlackRock is simply rebranding the same strategy under a new name: transition investing. They are still buying the wind farms and solar parks, but now they are buying the coal plants and gas pipelines too. They are hedging their bets, ensuring that they profit regardless of whether the green energy transition succeeds or fails. This is the classic heads I win, tails I lose strategy, and it has worked spectacularly. Perhaps the most striking element of the current institutional repositioning is the embrace of Bitcoin, and what that embrace actually signals about the state of sovereign debt. For years, Larry Fink dismissed Bitcoin as an index of money laundering, a speculative toy for criminals and anarchists. Today, BlackRock's IBIT ETF is one of the largest holders of Bitcoin in the world, accumulating billions of dollars worth. That is a 180-degree reversal. And it is not a change of ideology. It is a recognition of the sovereign debt crisis we have been discussing. Bitcoin has properties that are genuinely unique among financial assets: a fixed maximum supply encoded in its protocol, no issuing authority that can alter that supply through legislation or executive action, and no sovereign counterparty in the sense that a government bond has one. A 30-year treasury bond is a promise made by an entity that is currently paying $1.1 trillion per year, just in interest. Bitcoin is a mathematical proof. In an environment where fiscal deficits are large enough to constrain the central bank's ability to control inflation, what economists call fiscal dominance, an asset with verifiable, immutable scarcity has a specific and rational role to play as a portfolio hedge. By legitimizing Bitcoin, BlackRock is essentially admitting that the full faith and credit of the US government needs a backup plan. They are selling protection against the very system that allowed them to become the masters of the financial universe. There is an important distinction to understand, however, between owning a Bitcoin ETF and owning Bitcoin directly in self-custody. An ETF gives you price exposure. If Bitcoin's price doubles, your ETF value doubles. But you do not hold the Bitcoin. A financial institution holds it on your behalf. This reintroduces the very counterparty risk and third-party dependency that Bitcoin was originally designed to eliminate. BlackRock is financializing the exit ramp, collecting fees on the very asset that was designed to disrupt their business model. If the dollar survives, they win. If the dollar collapses and Bitcoin rises, they also win. The accumulation of Bitcoin by institutions is creating a supply dynamic that may eventually price the average person out completely, just as happened in the housing market. Now step back and look at the broader geographic picture, because the capital rotation happening right now is not only about asset classes, it is also about currencies and geographies. For the last decade, holding US dollar assets has been a winning strategy by almost every measure. The dollar strengthened. American stocks outperformed global markets by enormous margins. But BlackRock is now advising clients to look beyond that home bias. They are allocating capital to Japan, which is undergoing significant shareholder-friendly corporate reforms. They are also allocating to India, viewing it as a long-term demographic growth story, similar to China in the early 2000s. The math behind this diversification is direct. When a country runs deficits of 6% of GDP on a sustained basis, the mathematical pressure on its currency is real. The deficit has to be financed by issuing debt. If domestic and foreign buyers are less willing to buy at current yields, yields rise to attract them. Rising yields increase the deficit, which requires more issuance, a self-reinforcing dynamic. At some point, the adjustment mechanism involves the currency itself. Global infrastructure assets provide perhaps the cleanest currency hedge of all. A toll road in Australia, a port in Southeast Asia, a pipeline in Europe generates revenue in local currencies and serves local economic needs. If the dollar weakens relative to other major currencies, the dollar value of those revenue streams increases automatically. The assets themselves are indifferent to what happens to U.S. fiscal policy. Pipelines and ports do not care which currency is used to pay the toll. The weaponization of the U.S. through financial sanctions has also accelerated the diversification of central bank reserves globally. BlackRock sees the rise of the BRICS nations, Brazil, Russia, India, China, and South Africa, and the desire for trade settlement outside of the U.S. system. Countries that once held large dollar reserves as a matter of routine are increasingly holding a more diversified basket. Instead of fighting this trend, BlackRock is positioning itself to manage assets on both sides of it. This trend is gradual. It will not produce a sudden dollar collapse. But it does mean the structural demand for assets that sustained American borrowing terms for decades is slowly and measurably eroding. The exorbitant privilege of printing the money that the world uses is coming to an end, and BlackRock knows it. They are preparing for a future where the US is just one of several major economic blocs, not the sole superpower. The connection between this institutional capital reallocation and the American housing market is direct and worth understanding clearly because it affects millions of households in their most personal financial decision. The 30-year fixed mortgage rate is heavily influenced by the 10-year Treasury yield. When BlackRock and other large institutions reduce their appetite for Treasury securities and mortgage-backed securities, the lack of demand pushes yields up. Yields go up, mortgage rates go up, the average American home buyer pays more every month. The pool of buyers who can qualify shrinks, and this is not a temporary cyclical problem. It is the product of a fundamental reordering of how capital flows through the housing finance system. Into that constrained market, BlackRock and its peers are deploying capital at scale into build-to-rent communities, entire residential developments designed from the ground up to be rented, never owned. The model generates perpetual cash flow for the asset manager while denying tenants the opportunity to build generational equity. If mortgage rates stay near 7%, millions of Americans will be forced to rent for life. This creates a permanent class of renters and a permanent stream of cash flow for institutional owners of the housing stock. The American dream of homeownership is mathematically incompatible with the institutional dream of perpetual rental yield. And right now, the institutions have the capital, the access to cheap debt, and the political influence to win that battle. There is one additional fiscal pressure affecting American household balance sheets that often gets overlooked, and it compounds everything else we have discussed. The Tax Cuts and Jobs Act of 2017 reduced tax rates for most American income brackets and significantly increased the standard deduction. The corporate tax cuts from that legislation were made permanent. The individual cuts were not. They are scheduled to expire on January 1st, 2026. If Congress does not act, the standard deduction will be halved, and tax brackets will tighten for every working family. This is a programmed tax increase that BlackRock's analysts are well aware of and have factored into their economic models. They know that the consumer will be squeezed from both sides, higher taxes on income and higher interest rates on debt. This squeeze is exactly why they are reducing exposure to consumer discretionary companies and doubling down on consumer staples and utilities. They know you will cut back on vacations and luxury goods, but you will pay your taxes and your electric bill. The 2026 tax cliff lands on top of already elevated inflation, eating purchasing power, higher interest costs on any variable rate debt, and rising housing costs. The simultaneous compression from multiple directions is not a coincidence. It is the convergence of several independent fiscal and monetary trends hitting at the same point in the cycle. When the largest pools of capital reduce their exposure to consumer discretionary spending, they are making a specific bet about the direction of the average American household's financial position. It is not a bet in the direction of improvement. So, what does all of this mean practically for someone managing their own finances and trying to make sense of a macro environment that is shifting faster than conventional financial advice has adapted to? The first and most foundational step is addressing your relationship with assets that lose real value over time. Cash sitting in a savings account is a guaranteed slow loss of purchasing power in an inflationary environment. The goal is not to avoid cash entirely. Liquidity has genuine value and emergency funds serve an important function, but large allocations to cash beyond what you need for near-term liquidity are a guaranteed slow erosion of purchasing power. The inflation rate does not negotiate. The math is automatic. You must become, in a sense, your own central bank, allocating capital into assets that have finite scarcity and utility. This means owning your home if possible, because a home appreciates in nominal terms when inflation runs hot, and you are repaying a fixed rate mortgage with dollars that are worth less than the dollars you borrowed. That is one of the rare ways in which inflation actually works in a borrower's favor. It means holding physical gold, which has maintained purchasing power across centuries because no government can print more of it. And it may mean holding Bitcoin in self-custody outside the ETF system, where the mathematical scarcity is enforced by code rather than by policy, and where no institution can freeze or restrict your access. The second step is eliminating high-cost variable rate debt. This is where household financial vulnerability is most acute and most directly addressable. Credit card debt at 25% interest is not a minor inconvenience. In a sustained high-rate environment, it compounds faster than almost any investment return you could realistically generate on the other side. Every dollar you carry in credit card debt costs you 25 cents per year. Every dollar you invest has to earn 25% just to break even against that cost. Paying off that debt is functionally equivalent to earning a guaranteed 25% return. You must reclaim that cash flow from the institutions that are farming it from you. Variable rate debt more broadly, adjustable rate mortgages, home equity lines of credit, personal loans with floating rates becomes more expensive when rates rise and continues to drain cash flow as long as rates remain elevated. Eliminating this exposure reclaims future purchasing power that can be redeployed into real assets rather than interest payments. The third step is thinking seriously about human capital and where your skills and earning power are positioned in the economy that is emerging from these structural changes. As BlackRock pivots to infrastructure and AI, jobs in skilled trades, engineering, and energy will become more valuable. The tool belt class jobs that build and maintain the grid are immune to inflation and immune to AI replacement. The laptop class jobs that produce nothing but emails are at risk of being automated by the very AI data centers BlackRock is acquiring. Aligning your human capital with the same trends that the smart money is aligning its financial capital with is not a coincidence. It is the same underlying logic applied to two different types of assets. The asset that cannot be easily replicated or replaced has pricing power. Your skills work exactly the same way. Step back and look at the full picture of what we have covered, because the individual pieces connect into a single coherent story. The $38 trillion national debt, with $1.1 trillion in annual interest payments, is forcing a structural rotation of capital away from government bonds and toward real assets that have pricing power, physical utility, and inelastic demand. The rotation is breaking the 60-40 portfolio model that most Americans' retirement savings are built on. BlackRock's shadow banking transformation, through the $12 billion HPS acquisition and its private credit platform, is moving risk from regulated institutions to individual retirement savers without their explicit awareness. The push to include private assets in 401k target date funds threatens to trap retirement savings in illiquid vehicles during exactly the moments when liquidity matters most. The build-to-rent strategy is structurally locking younger Americans out of homeownership and into permanent renting. The tax cliff of January 1st, 2026 adds a programmed squeeze on household cash flow that compounds everything else. And the embrace of Bitcoin by BlackRock, by the firm whose CEO once called it an index of money laundering, is an institutional admission that the full faith and credit of the US government needs a hedge. The great moderation, that 40-year period characterized by falling rates, low inflation, and reliable bond performance, is officially over. We are entering a new cycle where capital costs are higher, liquidity is scarcer, and the premium for owning real things over holding paper promises is significantly increased. For the individual investor, this means the passive strategies that worked in the past may not work in the future. Simply buying an index fund and a bond fund may not provide the inflation protection required to preserve purchasing power going forward. BlackRock has shown us the playbook: sell government debt, buy real infrastructure, control the energy, embrace scarce assets. They are not acting out of malice, they are acting out of mathematical necessity in a debt crisis. You should not resent them for it. You should copy their homework and apply it to your own scale. The institutions are moving their money to safety, and they are doing it quietly, quarter by quarter, report by report. The great reallocation is not just a corporate strategy, it is a warning bell for every American household with savings. It is a signal to reevaluate your own exposure to US government debt and the purchasing power of the dollar over the long term. The separation between those who hold real assets and those who hold paper promises is about to become the defining economic divide of the next decade. The liquidity in the bond market is already deteriorating. We are already seeing evidence of this in the volatility in the repo markets, where short-term funding costs have become increasingly erratic as the largest players reduce their treasury positions. As the largest players step away, that volatility will increase, potentially leading to dislocations in price that hurt retail investors. You must be aware of this shift because your own retirement savings are likely tied to the very assets they are selling. Do not wait for a crisis to make your move. Follow the flow of the smartest capital while the window is still open. The era of blind faith in the system is over. The era of personal financial sovereignty has officially begun.